Fantastic. So I'll take over from the previous module of Brent that has introduced you to the notion of tax havens, that they're big, and the notions of residency and nationality that might help you unwind the capital allocations that are done to tax havens. Ultimately, what we're really interested in is figuring out the ultimate economic exposures. Who owns what around the world, and who is exposed to whom. And this has become extremely difficult to do with statistics that don't let you see through the tax havens precisely because they're so big. So what I'm gonna do in this session is take very, very basic facts that we think we know from the data about international macro and show you how they change once we take care of the capital that is in the tax havens. I'm also going to show you how to build, or how we build in our own work, a version of official statistics at the country level that is inferred from the microdata while taking care of these tax haven issues. I'm going to use 3 data inputs. I'm going to use official statistics at the country level. These are going to be from the Treasury International Capital for the US, and from the Coordinated Portfolio Investment Survey that the IMF provides for almost all other countries. And in a session about public data tomorrow, Jesse Schrager will dig much deeper into this public data. The second piece that I will need is something that Brent mentioned in the previous module, comes from our own research, and you can think of it as a mapping at the security level that maps the universe of all securities around the world from the immediate parent, the immediate issuer and the nationality of that company, which is the concept of residency, to the ultimate parent company and the country of that ultimate parent company, that is essentially the nationality concept. This is all based on commercial data. It's based on a number of 6 or 7 commercially available data sets. But we made the algorithm that we use to merge all this data together and create the ultimate allocation available for free online. It's on our website. On top of that, the algorithm will run on any subset of the commercial data. And most of the universities where the participants today are affiliated will have a number of these data sets already. So you can get quite far by just simply downloading the data that you're entitled to from the university and running it through the algorithm. Ultimately, we're interested in holdings. So we're gonna need data on who owns these securities. And we're gonna mostly rely on the data that Jesse Schrager introduced in the previous 2 modules, that is from Morningstar on mutual funds and ETFs. But I will also use data from other type of investors. So for example, for the US, I will use data on the universe of insurance companies from S&P. Or for Norway, I will use data on the Norwegian Sovereign Pension Fund. And our project is constantly expanding and trying to add more type of investors to the data. The way we're gonna take the microdata is we're gonna first build the mapping, apply the mapping to the Morningstar Holdings data. So we're gonna see how the Morningstar mutual funds and ETF investments get transformed as we take some of the securities away from tax havens and bring them to their ultimate destination. But then we're gonna try to generalize this to restate the country level positions for portfolios. And those, of course, include other type of investors that we don't cover. So what is the key assumption that we're going to make? We're going to assume that the data, the microdata that we use is representative within each year asset class and bilateral country pair of the overall portfolio investment. So it doesn't have to be representative across year or across asset classes or even across countries in a bilateral sense. It has to be within these classes. So it's a milder restriction. And of course, using other type of investors that I mentioned, we can verify it. We can verify what happens in the US data if we use only the mutual funds or we use the mutual funds plus the insurance. Or we can do it for Norway. What if we use only the mutual funds or we add to the data the micro holdings of this the Norwegian Sovereign Wealth Fund. And overall, we're satisfied that this is at least a major improvement compared to taking residency at face value. The way we're gonna do it is we're gonna build what we call the reallocation matrices. And all of these matrices are freely available online by investor, asset class, and country. Here I'm gonna focus on an example of the US corporate bond matrix. The way to read this is on the columns, I have the destination of investment. So here I'm highlighting US investment into the Cayman Islands. Sorry, on the rows. On the columns, what I will have is where the investment gets reallocated to once we use our mapping. So the way to read this 20% is to say that of all the investment in corporate bonds that the US makes in the Cayman Islands in 2017, 20% of that will go to Brazil on a nationality basis. 33% will go to China, and so on. But only 1.4% will stay into the Cayman Islands. Again, sort of giving you this sense that the capital that is flowing there is not staying there, that there isn't any economic activity taking place locally in the Cayman Islands. What we do is we start from the official data. So here the red column tick is the official residency data of the US foreign investment into corporate bonds, and I have the destinations. If what I do is I take this vector and I multiply it by the matrix, I will get a finished product that is nothing else than the official data restated using our mapping. And in fact, one of the problem sets that we put online pushes you precisely to go through that calculation so that you can see exactly how it happens. We're gonna present you two versions, one that only restates those investments that are made in tax havens, and one that we're gonna call full nationality that restates everything, including domestic investment. What are big patterns that emerge immediately when you do the reallocation? The first one is that investment from the US to countries like Brazil, like emerging markets, that looks extremely small in the official data. There is only 8 billion in the official data of US holdings of Brazilian corporate bonds, goes up by an order of magnitude. It immediately jumps to 50 billion. And that should remind you of the example that Brent gave you of Petrobras. Since a lot of the investment of the US in Petrobras will be in their subsidiary in the Cayman Islands, it won't be in the official data, but it will be included in the tax haven only estimate. This happens more generally for a lot of emerging markets. You can see China going for absolutely nothing. The US official data says they only own 3 billion of corporate bonds in China to 47. Russia, where they declare roughly holding zero is a rounding, actually going to 12 billion. That should remind you of the example of Gazprom raising capital from American investors through its Luxembourg subsidiary. Who's losing the capital? Well, it's the tax havens, almost by construction. The Cayman Islands go from being quite large, 80 billion, to being 1. Ireland goes from 63 to 24, Luxembourg from 72 to 3. So you can see that the allocation is going away from the tax havens and in part to large emerging market economies. I want to convince you that that's not a US phenomenon. So here, what I'm doing is the red data, sorry, the red histogram is showing you in the official data what fraction of external bond investment is in what are called the BRICS countries: Brazil, Russia, India, China, and South Africa. And you can see that it's not just the US that seems to report very low investments. You look at the EMU, you look at Canada. It seems puzzling that only 2% of all foreign bonds that these countries own on average are in these large emerging markets that are growing quite fast. And indeed, as you correct the statistics of these countries and you go to nationality, you can see a large jump for almost all countries into the amount of investments. The US goes from just over 2% to being 7%. If you do the same for equity, there is a staggering large pattern. If you ask in the official data, what fraction of foreign equity investment of any of these large developed investors is in China, it looks tiny. It's only 2%. That seems rather strange given that Chinese companies like Alibaba, Tencent are a big part of the world stock market. And what is really happening, and I'm gonna dig much deeper in a second into this, is that a lot of these companies are under residency located in the Cayman Islands. So for the US alone, if you correct the data for tax havens, the US investment in Chinese companies jumps from being 2% of all foreign investment into equity into being 10%. It's almost a $500 billion or just over $500 billion difference. Now this changes completely the picture of risk exposure. For example, a lot of the policies that are being discussed right now about the Trump administration trying to force a delisting of these companies from US stock exchanges, should they not satisfy some accounting requirements, don't take into consideration the real exposure that we're talking about. It's not so small. It's actually $500 billion bigger than the official data would report. You can also think of a very different mapping. So here on the left, I'm gonna use a similar picture to the one that I did before for Chinese equities, but using a very different notion of nationality. Maybe what we're interested in is not so much whether the company is Chinese, but how much of a company's revenue is generating in China. And here what we use is a data set from FactSet that tells you for many public firms and for many large firms around the world, the geographic composition of their revenue. So rather than doing a 0-1 exercise where you're either a firm in the Cayman Islands or you're a firm in China, we distribute a firm continuously according to where its revenues come from. And on the graph on the left, on panel A, I do exactly the same exercise as before, but now I imputed the country based on sales. And you can see that the exposure to China goes up even more. We're now talking for the US of an increase of over $1 trillion, or 15% of all the foreign equity holdings. Why is that happening? Is because many companies that are not Chinese to begin with receive a large fraction of their revenue from China. Similarly, if I look at the right-hand side, this notion of sales might change your view of how much of the overall investment happens domestically, what we discussed before as home bias. Why? Because let's consider the case of the US. Well, the US investors hold a lot of domestic companies of the US, but these companies themselves might make a lot of their sales abroad. And so if you compute a version of home bias based on sales rather than on residency or nationality, you get a lot of investors receive massive global exposure through their domestic investment because the companies themselves are exposed to foreign investment. So it really changes quite meaningfully the picture. I now want to spend some time digging into this Chinese element because it's going to bring us back from to all the way to one of the first modules in these sessions where Brent talked about net foreign assets and foreign liabilities and foreign assets and why do we care and how they're measured. So if you think about the standard way we invest in companies, you have foreign shareholders, they're buying equity in a company inside a foreign country, in this case, China, and then there might be some domestic holders. That's not what happens for the vast majority of equity investment in China. Why? Because China restricts investment from foreigners into strategically important sectors, technology being one of them. So what do the companies do? They create a very sophisticated structure called a variable interested entity structure, and we're by no means the first people to notice this. There's a long legal sort of scholarship on this, but it has a particularly important implication for international, which we want to highlight. So think of this listed company as being Alibaba. They're listed on the New York Stock Exchange, but this company is not in China, it's actually in the Cayman Islands. Then the company controls a WFOE, a wholly foreign-owned enterprise. This is an entity in China that will not operate in a restricted sector. It will, for example, not operate in technology. And then what this company does is that it has contracts with both the operating company, what you and I mostly think of as Alibaba, the company operating in China, and with the owners of Alibaba, like people like Jack Ma. What do these contracts allow? They're essentially allowed to replicate equity in terms of being both control and a right to payments without being equity. They're going to include things like power of attorney or a loan to the company where the collateral is the entire asset base of the company. They will also include something like a fee structure that will say, we will provide to you or to Alibaba consulting services on your website. And the fee for that is your entire operating profits. So you can see that they achieved the following seemingly miracle, is that the foreign company, according to international accounting standard, can consolidate the WFOE and claim that to the foreign investors that when you buy an equity into issued in New York into Alibaba, you're buying a share in the company. At the same time, the company in China will be able to represent to the local regulators that they have no foreign equity holders because the contracts that are signed locally are not quite equity. Why does this matter for us? It matters because if we go back to the identity of net foreign assets being assets minus liabilities, and the change being the current account, in some sense, the transactions versus the valuation changes, this component that Brent showed you is quite big, the valuation changes. It's going to be difficult to measure once you have this complicated structure. Why? If you go back to the previous example, the traditional structure is pretty easy. If the company in China, their equity value doubles, the portfolio liabilities of China will generally double in value to reflect the fact that what the foreigners own in China has now doubled in value. But if you go through this much more complicated structure, what the liabilities are, there are a series of contracts. Here I'm representing them as being two, but they're really, like in practice, hundreds of separate contracts that need to be evaluated. And this delinks, even if China is doing everything right in following the rule books of how you do international accounting, this delinks the value of each of these contracts to the listed value of the company in the New York Stock Exchange. And I'll show you that this is actually quite a big deal. The value of these companies listed abroad has skyrocketed in recent years, has gone from being pretty close to zero to being over 2 trillion. At the same time, if you plot the entire stock of FDI, one thing I should have highlighted is that these contracts are no longer portfolio investment. They're going to be mostly FDI or other loans. If you plot the entire stock of declared liabilities from China vis-a-vis Hong Kong, the British Virgin Islands, or the Cayman Islands, the countries where these liabilities are most likely to come in from, they just don't add up. The value of these companies even has exceeded the total value coming from these countries from any source of liability. Moreover, we can make use of a particular period in time, the period between 2016 Q4 and 2018 Q1, where the market value of the VIEs went up by over $1 trillion. These are unrealized, in some sense, capital gains. The value of the existing stocks raised in dramatically. And then you can ask, did any of these show up in the official liabilities of China in the gross liabilities and therefore in the net foreign assets in any category, whether it's FDI, portfolio, loans? And the answer is no. So this gives us a lot of confidence that this increase in value in the liabilities has not been recorded. And you can, on the other hand, we're pretty confident that the asset side, so the foreign investors are recording it. This is showing you the value of a reported investment in equity from TIC in the Cayman Islands. This is what the US officially reports owning in the Cayman Islands in common equity versus the stock market value of these Chinese companies. And you can see it's almost identical. Similarly, South Africa, a company called Naspers, has a very large share, a 31% share in Tencent, one of the largest VIEs in the world. And you can see that the official foreign assets of South Africa, as far as the bilateral component goes, they reflect this almost perfectly. So the problem is really on the Chinese liabilities because of the structure. So if we go back to a graph I showed you in the very introductory section today, where I plotted the net foreign assets of China. So what in net China credits to the rest of the world, this is quite large. It's about 2 trillion or 15% of Chinese GDP. Now, what we asked is, if we correct the data for these Chinese companies resident in tax havens, and for the fact that we have evidence that the official liabilities of China don't reflect the full market value, the full equity value of these listed companies abroad, how much would the picture change? And the answer is quite a lot. You would conclude, this is the red line, that China is only 50% as much of a creditor to the rest of the world as the official data would tell you. This provides you a first order different picture from one of the most important global imbalances. The idea that China was such a big creditor has been politically sensitive with the US, has certainly been the attention of the IMF in a lot of the literature, for example, on currency manipulation. There's been a lot of policy time spent on trying to shrink this imbalance. And a lot of it has happened and we hadn't quite realized as economists or policymakers because of the way we look at the data. So this provides you a meaningful different look. I'm gonna stop here and we can stop the recording. I want to mention a couple of things very briefly and then open it for questions. One is a lot of the data that we showed you today, it's available for download on our website. And there's a problem set that we listed that you can go around and play with it. I think you really want to think of the kind of data that we put out there as being in two types. One is slightly more aggregated than the micro data that we use for our own research. So they're more aggregate statistics that we shared in support of our papers. And then there is code that should, a lot of, in fact, all of the data that we use is commercially available, so you can purchase it. And part of what we want to do for students is to make it easy to go and approach the vendors, buy the data, and use our codes to speed up. Even after you get the data, it's not so straightforward, and the next day you're going to be able to start doing research. There's a lot of time and effort that goes into transforming the data in useful ways. And the codes will hopefully sort of allow you to do this much quicker. And a lot of other researchers, including professors, are doing this. And so we think it's a fruitful area. But let me stop here.